a lot of exotics. You have the Mexican pesos. You have all sorts of things, and it's pretty great how you can really trade all these currencies and make a living off of it. It's insane. And of course, you have the indices, right? Now, what are indices? Indices are like Nasdaq, US 30, SPX 500, German 30, UK 100. Those are great pairs to trade, and I definitely recommend trading them within their time session. Within the New York or London, definitely trade German 30 within the London session, and definitely trade US 30 during the New York session. And of course, you have the commodities, right? Now, commodities is like oil, metals, right? So we have oil, we got gold, we have silver, we have platinum. We have all these wonderful pairs, right, that you can trade against the US dollar, against the euro, or just really any other currency as well. Also, you have the cryptocurrencies. We already know what that is: Bitcoin, Ethereum, Litecoin. It's just so great. And that market is open 24/7. Forex market opens up at 6 a.m. Sydney time and is at Friday, 5 p.m. New York time. So always remember that 6 a.m. Sydney time on Sunday, and it ends 5 p.m. during the New York time. So 5 p.m. Eastern Standard Time for me, and 5 p.m. Eastern Standard Time on Sunday for me as well. Of course, if you have a different time zone, definitely find out when the time, like the perfect time frame is and everything, because it's extremely important to know, of course, when's the Sydney session, when's the Japanese session, or the Asian session, when's the London session. It's very, very important to know, and we'll go over that more as well too. All right, so the past history of the foreign exchange market, the first trading system was the bartering system. Then eventually we had the commodity system, right? That's when they were trading gold and silver frequently. Then what we have now is called the Bretton Woods system. And I guarantee you within the next 20 years from now, they're probably going to introduce another system. And I guarantee you crypto is probably going to take over just a little bit. It's possible. It's very possible. Probably be called the crypto NFT system or something. But we'll definitely see what happens. But definitely the barbering system that was long, long, long time ago. That's when, we had cavemen trading sticks for a piece of wood or just anything. It was really crazy. But during like the commodity system, that's when things really began to change and a big shift really started to happen. And of course, here we are now. We have currencies and we have digital currencies, which is a part of the Bretton Woods system. So, of course, like I explained, what is traded in the market, of course, all currencies, all cryptos, even of course, the commodities. And of course, you can even trade stocks like Amazon, eBay, Tesla. You have so many stocks that can be traded within the market. It's insane. That's one of the most coolest things I've ever found out, honestly, was finding out that I can trade stocks on MetaTrader 4. That was insane. When I found that out, I was like, ain't no way. They done messed up. But honestly, that's why there's so much opportunity. And traders usually don't know how to utilize these opportunities, right? And make the best out of it. You have to be really abundant when you're trading. Because there's so many opportunities, there's so many pairs, there's so many things you can trade. It is insane. And all it really is just understanding the nature of the market to be successful. And of course, controlling what you can control at the end of the day. And of course, you can also trade Dogecoin. I found that out during the summertime. Now you can trade Dogecoin on MetaTrader 4. That was really crazy. I tried that out a couple times. It was okay. I usually don't frequently trade that, but I might as well try it again. Why not? But honestly, you can trade Bitcoin, of course, Litecoin, and so much more. There's so many opportunities in the market. Like it says right here, it's endless. And when I tell you it's endless, it is endless. And a lot of times traders get mixed up. They're like, oh, they got the scarcity mindset, like, oh, I got to do this now. And, just so impatient. And that's why they wonder why, oh, they're not so successful, is because they're not patient. When you're trading, I'm telling you right now, where is your success going to come from is from you being patient and consistent. That's all it is. That's all it is. Because we're so programmed to have everything right now, and we're programmed to be dependent, right? That really helps the market out, the institutions, right? Because we're programmed to be like that. And that's why they're really manipulating the market so much. That's why so many traders are failing, so many traders are quitting every single day because of their manipulation tactics. So you have to beat the programming, of course, and reprogram to a better self. Also, market trends, right? You have uptrends and downtrends. An uptrend consists of what? Higher highs, higher lows. A downtrend consists of what? Lower lows and lower highs, right? When you're looking at the market's either going to be bullish or bearish. There's no in between. There's no bullish, bearish, bearish, bullish. It's either or. You have to look at structure. You have to look at the anatomy of what's going on, and you just have to just accept what's going on because the market's going to tell you. The market's not going to lie. What it does is it just does whatever. It honestly just does what it wants to do. The market can really stop me out right now. It happened earlier today. I had a trade. I got stopped out. It was US 30. I'd taken partials and everything. So I have an exit plan when I trade. I'd taken partials, and then all I remember was, boom, partials were taken. Next you know, stop loss got hit. And then, of course, from there, what happened? It flew all the way up, hit my TP within like 2 candles. Why does it do that? Because it's the nature of the market. It likes liquidity. And what it likes is going to get. It's going to get it, and it's going to move with it. The market loves liquidity. And if you don't know what liquidity is, then definitely reach out to me because I'll definitely explain more of that to you. But liquidity is something that's so essential to the market because they love taking liquidity out constantly on a day-to-day basis. And it's never, ever going to stop taking liquidity. That's all the market does is take liquidity and make a move. And of course, I'm going to be showing you all an example. So let me get this shown up right here. Let's take a look at what an uptrend is. All right, so this is US 30 right now. And this is looking bearish in the 5-minute. But I'm going to draw you all an example. All right, so when we're looking at an uptrend, right? First things first, what is an uptrend? An uptrend consists of higher highs and higher lows, right? And let me scoot this out a little more. And why does the market make higher lows, and what are higher lows? It's just slight retracements to take more liquidity to make more moves. Takes liquidity out, makes another move, goes up, right? Let's take another look. Boom. Same thing happens again, right? Another higher lows form, more liquidity is taken out, breaks structure again, makes a higher high. So this one right here is an example of a higher high, and I'm going to write down everything. So make sure you write this down, screenshot it, do whatever you got to do. Oops, excuse me. All right, so first things first, uptrends, right? Consist of higher highs and higher lows, right? So make sure you write this down, screenshot this, do whatever you got to do. Did everybody get this down? Going once, going twice. Hope everybody got this down because I'm going to keep moving. Cool, cool, cool. All right, so always know, uptrends always consist of higher highs and higher lows at all times. Next, we have downtrends. And what do downtrends consist of? Lower lows and lower highs. That's what we have going on right here, honestly. But I'm going to draw this out as an example, right? For a downtrend, we have the lower low that's formed, then the slight retracement, taking out more liquidity, right? That's exactly what it does. Takes liquidity, breaks structure. That's what the market is always known for. Takes liquidity, breaks structure. Gonna do it again. Makes a lower high, then makes that lower low. It's just that simple. That's what the market does on a day-to-day basis. This is the nature of the market. Consists of lower lows and lower highs. So if you didn't get that down from the slide, definitely get this down right now. Downtrends consist of lower lows and lower highs. Write it down, screenshot this, do whatever you got to do. Just make sure you get this down because it's extremely important to know. And it's the same thing like an uptrend. All it does is take liquidity out and continues its move. And always remember this. The lower time frames always make the higher time frames. The 5 minute, as we see, right? The structure in the 5 minute is really continuing and forming structure for the 4 hour, the daily, the weekly, and the monthly. It gets really that deep. It gets real deep. But more importantly, though, downtrends consist of lower lows and lower highs. Make sure you have that written down. And uptrends consist of higher highs and higher lows. Everybody got this written down?
Yep, got it.
Great. That's extremely important to know. I promise you. It's extremely important. Because if you don't understand this, then you're just not going to understand trading really like that in general. And we take a look right here. Right? I think I see a trade in there. Oh, snap. I think I could take a trade in my I ain't going to show y'all too much, but just know I could possibly take a trade. But one thing I will say is if we take a look at structure right here, right? What is it doing? It's making lower highs, lower lows, lower highs, lower lows. Right here, it was doing a little bit of some ranging. Takes the liquidity out. Now it's starting to make its move back up. That's exactly what the market does on a day-to-day basis. I promise you. That's all the market likes to do. It just likes to take liquidity out and make a move at all times. That's all it does. I promise you. That's all the market wants is liquidity. Is the liquidity from your trade. They know how everybody trades, I promise you. They know everything. And not only that, it doesn't even matter if they really know everything because they have so much money, so much capital that they can really cause breaks of structure in the market and cause other wonderful things to be formed and created to fool traders on a day-to-day basis to make you look bad and to make you want to quit trading. That's what their job is. And I'm going to be honest with you, the institutions, the people behind the screen that are trading, breaking structure and making all these wonderful moves, a lot of times don't really understand what's going on. They're just being told what to do and they're just executing. That's all they're doing. But of course, we have the London session, the Sydney session, the Tokyo session, and the New York session. My preferred sessions is the London and New York sessions. And if you just saw my most recent post, I just made a post about this because during the London and New York sessions, there's a lot of volume that is in that session, especially the New York session. It's a lot of volume, right? And I trade with smart money concepts. And along with smart money concepts, it allows me to, of course, take more higher probability trades. Now, if you're taking a trade during the Tokyo session where there's less volume, you're most likely going to be swept or, Stop loss is most likely going to be hit, honestly. It's a higher chance. You can still trade in any session. It doesn't really matter. In like any session, they all do the same thing. Just take liquidity, makes its moves. But the London session is, for me, it is 3 a.m. to 12 p.m. The Sydney session is 5 p.m. to 2 a.m. The Tokyo session is 7 p.m. to 2 a.m. No, 4 a.m. These are all Eastern Standard Time as well. And the New York session goes from 8 to 5 p.m. Eastern Standard Time. I love the New York session, and especially my FCT traders know I love the New York session. I love that session with a passion. That's where I trade. I can sometimes go in the London session. There's also great setups in there. There's also great volume that is formed in there as well. And there's also really a nice amount of high probability setups within that session as well. So it's all about finding what works with you, what session you feel comfortable with, and what session you can execute the best. And where do you find that out? From back testing. But next, all right, so we got pips and lot sizes. A pip is a point in percentage. A lot size is the initial active investment you put into a trade, right? A pip count goes up or down depending on the market movement. So to find the pip difference, subtract two numbers, right? So you want to figure out how many pips this is. So this is an example right here. Let's say got 3,180 minus 200. Minus 2,990. That's 190 pips, right? With a 0.1 lot size, that would be $19. With a 0.1 lot size, that would be $190. And with the 1.0, which is a standard, that would be $1,900, right? A 0.01 is a 10-cent micro lot. And the 0.1 is not my favorite anymore. It's not my favorite, trust me. Standards are my favorites. But definitely it's a dollar mini lot. Then, of course, you have the standard lot. I like my standards because that's just how I trade now. I don't use the mini lots as much anymore. That was long ago. But standards are definitely my favorites. But, of course, over time, sometimes you can have some trades that may have a really fat stop loss and you may not be using the standard. That's totally fine. As long as you're using the correct risk every single time, you have great money management, then by all means, you're good to go. It doesn't matter so much of what lot size you're using. A lot of times people are like, I want to use a standard. I want to use this fat lot size. It doesn't matter. Like if you have poor risk management, then it just doesn't matter, right? You take one trade, you risking half of your account just to use a fat lot size, just to look cool, to show your friends. And then next you know, more than half of your account is gone. Like everything is gone. And then you just sitting there like, wow, why did I just do that? Right? You don't want to be like that. You don't want to be that type of trader that's risking too much. You want to understand what lot size you have to use and go from there. Of course, right? Let's say your account balance is $1,000. Got a $1,000. Okay, I was about to say your account. So let's say you're risking 1%. Okay, I think that's $1 million to be honest with you. So yeah, let's say you have $1 million and you're risking 1% of that, and that is 10,000, right? Take the amount you're risking divided by the amount of pips the stop loss is. Let's say it's 25, for example, right? Then you divide it by 10. Then you'll get a 40 standard. So it's all about taking the risk, how much you're risking, divided by the stop loss, how many pips the stop loss is, then divide that by 10. Let's do another example right here. Let's say, for example, let's say $80. So do this with me, everybody. If you have a calculator on your phone or you got a calculator nearby, do this with me. If you don't know how to calculate a lot size, you're going to figure it out right now. So let's say you're risking $80. You have $80, and let's say you have a 5 pip stop loss, right? Because how I trade, I get 5 pip stop loss, 1 pip stop loss, 2 pip stop losses. Even on US 30 and NAS, I sometimes get like 40 to 50 pip stop losses. But let's say it's 5 pip stop loss, right? 80 divided by 5 is 16. 16 divided by 10 is 1.6. So what will my lot size be? A 1.6 standard. And as you always use correct risk management and you love seeing standards, then of course, you're going to see these a lot more as you keep using correct risk management and you keep scaling your account and you keep doing everything the correct way. The more and more you do everything consistently, you do everything the correct way, you do everything with diligence, then by all means, you are really going to see everything you want to see. I'm telling you right now. A lot of times traders want to see everything right now. And then a lot of times when you want to see everything right now, you're going to see all the bad side of it at that exact moment. I promise you. So you never want to be that trader that is rushing to just do anything. You never want to be like that. So we have pending orders. With pending orders, you have different positions traders open up when they want to trade in the market. So you have the market execution, the sell limit, the buy limit, the sell stop, and the buy stop. How I trade, I use limit orders. I use the buy limits and sell limits because it's very automated. I like automated trading. Also, sell stops and buy stops are automated as well. But more importantly, market execution, right, allows you to enter in the market instantly. So it's instant action. Once you click buy, it's a done deal. So you never want to click market execution on accident and then click buy and you accidentally are in a trade. Now you're risking your capital for no reason. You never want to be like that. Never, ever, ever. And then of course you have the sell limit, right? You're placing an order at a specific future price. It will activate literally when price hits the area. And of course, you have the sell limit, which is so great. I like those. I use more of those than buy limits, to be honest. But with buy limits, same as sell limit, but you're placing a buy limit instead. You're placing that order at a specific future price. And then once it activates and it does its thing. It is so simple. And even with sell stops and buy stops, sell stops are placed below price and buy stops are always going to be placed above price. So always remember that. And if you need to write this down right now because it's extremely important that you understand the differences between all of these. I personally, like I said, I use buy limits and sell limits because of how I trade with smart money concepts. But let's say you don't trade with that, or you don't plan on trading with that, or you don't like that type of style, which would be pretty much a shame, but hey, it is what it is. Everybody got this down? Cool. All right, so the types of market analysis. At the end of the day, when it comes to trading, I'm going to say this right now. It's not so much of the analysis, it's all psychology. It is 80% psychology, 20% analysis. It's just like sports, right? You know how they say, oh, sports is 80% mental and the rest is physical? It's the same exact thing. I used to think it was 80% analysis and you had to be the smartest guy on earth to really master this. No, you do not. My dog can probably trade. I guarantee it. I could teach my dog how to trade and she'll probably use her paws to click and probably make some money, get some treats or something. But it is so simple, right? So simple that you just must understand that it is strongly your psychology and your discipline, which is going to get you successful. So first things first, you have a couple analysis. You have the technical, the fundamental, and you got the sentimental analysis, right? And I usually use the sentimental analysis because I do trade with smart money concepts and everything. But with technical analysis, you're looking at the combination of support and resistances and also trend lines within the market. Then you got fundamental analysis where you're looking at the news, the world events, looking at everything that's going on within the news. I personally do not care about the news. The news can say something wild like Forex is falling or something just very crazy. It does not affect how I trade. That's just the moral of the story. An example of it, right? Negative news in the US dollar, which caused the value to weaken, causing any currency to gain strength that is going against it. In conclusion, it makes the pair go up. And going up is going what? Going bullish, and vice versa, right? Also, you have the sentimental analysis, reading price action, understanding how the price is feeling, reading candlesticks, wicks, understanding that the buyers and sellers are in control of the trades, understanding everything that's going on, seeing the wicks, seeing what's going on, if it's bullish or bearish structure. It's just understanding the anatomy and the nature. That is what it is all about. And that's really the best way to analyze the market, is really looking at the nature of it, because it's really going to help you regardless if you trade with smart money concepts or not. 100,000%. Of course, the beauty of Forex, you're able to make money from buying and selling. When the market is going long, get ready to buy. If it's going short, get ready to sell. It is honestly just that simple, right? And I'm going to show you all an example. Just real quick, let me get it. Boom. We'll wrap things up real quick too. Right? So let's say, for example, we're looking at US 30 right now. And this is how you literally place a long position or a short position, a buy order, sell order. You literally go all the way down here where it says prediction and measurement tools. So on TradingView, you have, of course, your login area right there. Then you have the cross, the arrow, the Fibonacci rectangle, the shapes, the text buttons, the patterns, and of course, you got the prediction and measurement tools. You go there. Say if I want to buy right now, instant execution, place my stop loss right here, make my trade a 1 to 16. Then by all means, you can do that, right? Same thing with the short position. You can do the same exact thing. Let's say I want to do instant execution. You get the short position. Boom, place your stop loss right above here. Wherever you need to place your stop loss above, place your target area, wherever you need to place your target area at. And of course, you just go from there. Same thing with buy limits, sell limits, buy stops, sell stops. It's all the same thing with applying the short position or long position. It's just all about, of course, your position and how you're trading, your trading style. Does that make sense, everybody? I know it can get confusing with, of course, finding that long position and short position.
Yeah, that makes sense.
Great. Love to hear. So let me go back here. But it's honestly very simple, and just understanding, of course, on placing that long position, placing short positions in the market. And if you don't know how to do that, trust me, you want to figure that out as soon as possible, because that's where you trade, right? That's how you trading in the market. That's exactly it. All right. So I'm going to show y'all one last thing, and then we're going to wrap it up here. So first things first, of course, I kept stressing about the institutions and the banks and just everybody, right, in general. Take a look. Who are the market movers? The commercial banks control the market. I'm telling you right now. And also the central banks hold a large currency reserve, holding those monetary policies, those interest rates, and much more. Then you have the hedge funds, the brokers that manipulate the rates and the spreads. Also, you got us, the retail traders, that we trade with our own capital. And of course, we control the smallest share of the market. It is unfortunate. It is like that, but it is what it is. That's why, as a trader, you always have to position yourself using great money management to be successful at all times. Correct positioning, correct risk management, correct discipline. It's going to take you a long way, 100,000%. Because you have to always realize this. The banks are in control of the market. You're not. I thought I was at one point in time. I thought I could control it, but nope. They just kept showing me why every time. Don't let the market make an example out of you, because it really will. It will show you your true character, and you never want to let the market take advantage of you. Take advantage of the market, because at the end of the day, they can't control what you can. And you know what that is? Your risk management. They can't correct, they can't control, they can't do nothing about your positioning as well and your discipline. The market's going to be the market. It's what it is. It's going to do its thing and keep on moving every single day, every single hour, every single minute. That is just the nature of the market. But other than that, that wraps everything up for tonight. If you have any questions, feel free to DM me. Or if you want the email to my support team manager, his name is Robert, let me know. I'll send you his email. If you have any other questions, let me know. Thank you all for showing tonight. This is just part one of the boot camp. Part two will be tomorrow at the same exact time. So I'll be seeing you then all then. No problem. No problem.